What we're going to be talking about in this video is put options, which are the opposite of call options. If you recall in the last video, we talked about call options, which give you the opportunity to buy a security at the strike price on or before the expiration date. Put options are the opposite in that they give you the opportunity to sell a stock on or before the expiration date. Now with that said, if you haven't watched the calls video yet, definitely do that before you watch this video. You can see here in the picture-in-picture that there's a lot of technical things that go on with contracts. You want to make sure that you have an understanding of calls before we venture into puts. In this video, we're only going to briefly cover the technical side of how options work, and instead we're going to focus on how to use the Robinhood platform to trade put options. So if you haven't already watched the calls video, do that first. So let's very quickly talk about why we might want to use a put strategy. So let's say you've done some technical analysis on WSB, the WallStreetBets company. In the middle of September, you see that it made a gravestone doji and you think the stock is now going to go lower. So traditional wisdom might tell you that you're going to want to short the stock. If you want to short 100 shares at 25, you want to have at least a little bit of buffer against a margin call. So you'd need at least $3,000 to short 100 shares at $25. So if you shorted at 25 and then covered at the stock's previous support at around 15, you'll have made yourself $1,000 on those 100 shares, which is pretty good. Now let's relook the same scenario through the context of buying puts. The same technical analysis checks out. You've noticed WallStreetBets is getting support around the $15 mark, and it recently made a gravestone doji, which is a very bearish signal. So let's say you don't want to short the stock because you're not willing to risk a margin call and you'd rather go for a bigger paycheck by buying puts. So let's go ahead and take that same $3,000 and buy 100 put contracts at a strike price of 15, expiring in October for a total of $3,000. Now you're in control of 10,000 shares for the next month. Now when WallStreetBets makes its precipitous $10 a share dive, you're not just short 100 shares and walking away with $1,000. Instead, you're in control of a very powerful financial instrument that will let you sell up to 10,000 shares at $15. When that contract was $10 out of the money, those contracts were worth about $30 each, and honestly, that's kind of a high estimate for the scenario that we created. Now, those same contracts that are at the money are probably going to be worth closer to $150 each. For contracts that are at the money with still 3 weeks to go for expiration, the contracts that you now hold are wildly valuable to somebody who needs to hedge, and they will buy them from you at a solid premium. In this scenario, we've turned our $3,000 initial investment into about $15,000. Multiplying your initial investment by 5 puts a shorting strategy to shame. So let's head on over to Robinhood and we'll run through a real-world example. This is my real Robinhood account. Obviously, there's very little money in it since I actually don't like Robinhood that much and prefer other platforms. I just have some leftover shares from when I signed people up. But anyway, let's go ahead and check out Disney for our put strategy. So Mickey Mouse really has had one heck of a year. You can see here the price increased dramatically, but it looks like it might be topping out. If you do some technical analysis, you may see a left shoulder, a head, and then finally a right shoulder, indicating that we might be looking at the early stages of a head and shoulders pattern. A head and shoulders is a pretty bearish signal, so maybe the stock price will drop to its previous resistance at about 115, or it'll act as a new support. This might be a good candidate for put options. So let's click Trade Disney Options. When you open up the chain, make sure you're on buy and you're looking at the correct strategy. We've heard all kinds of excuses on WallStreetBets. Oh, I meant to buy calls, but I accidentally bought puts. Nobody wants to hear that, so tighten it up and make sure you're buying the right thing. You want to avoid FDs where possible, so let's look at September 27th for an expiration date. Remember, our analysis indicated that the stock will likely go down to about 115. However, we don't want to buy the 115 strike because if it were to go down to that price at the expiration date, then the contract would still be worthless. So let's pick a strike slightly above our expectation. In this case, the 120 strike price seems pretty good. It's selling for $18 a contract. So let's go ahead and buy 100 contracts of it, and that'll cost us $1,800. Now we have the right to sell up to 10,000 shares at $120 at any point on or before September 27th. So let's say our prediction comes true, and within the next 2 weeks, Disney's stock price drops down to 120. You would certainly have made money, but how much? There are some fancy formulas that you can run to determine how much your option should be worth. But this is WallStreetBets, so we're going to use a shortcut instead. When we bought our put options, we were $17 out of the money and 4 weeks from expiration. In our new hypothetical, we are at the money and we are 2 weeks from expiration. So here's the trick. You want to open up the options chain and pick an expiration date 2 weeks from today and take a look at what the premiums are going for at the money strikes. This should give you a pretty good estimate of what your contracts will be worth 2 weeks from today if your strike is at the money. So we can see in our example that if Disney were to drop to our strike price 2 weeks out from expiration, the premium should be going for around $2, maybe up to $2.40. Our $18 investments are now worth over $200 each. So let's go ahead and recap our example so we can drive home the point of what put options are for. We did some analysis on Disney stock and think that the price is going to drop to at least $115. We want to give ourselves a little bit of a buffer, so we bought 100 puts at $120 strike price 1 month out, and those cost us $18 each. Do the math and you'll see that we spent $1,800 and we now control 10,000 shares that we can sell at any time before the expiration date for $120 each. For purposes of example, let's say that our analysis was correct and Disney stock dropped to $120 2 weeks before expiration. If we use our trick to estimate what the price would be, we can see that options trading at the money about 2 weeks from expiration are going for between $200 and $240 each. So we're going to do the smart thing and sell those contracts for $200 each. And congratulations, we just used put options to turn $1,800 into $20,000. This definitely sounds too good to be true, but on WallStreetBets you'll see many examples of people putting this into practice every week. Here's an example where Anal Farmer 2, whose story is incredible by the way, made $277,000 in 1 day using SPY puts. Here's another example where Disagabella or something like that went from $2,000 to over $70,000 in a month just by using a couple of different put strategies. But make sure you're not looking at put options as a golden ticket. Here's another example where Anal Farmer 2 got destroyed by poorly using his option strategies. He took too much risk and ended up losing over $230,000. Keep in mind, option strategies like this are high risk, so only put down what you are willing to lose. It is very important to remember that. But just to end on a good note, here's Anal Farmer 2 again, this time making over $183,000 in 1 day using options. These can be a very, very lucrative strategy. So that's it for this video. I hope you all learned something. Please do be conservative when you're using your options, but do look for opportunities to incorporate them into your strategy and look for those big gains where it makes sense for you. If you got something out of this video, please do like and subscribe and keep an eye out for more videos. In the next series, we'll be discussing more conservative option strategies where you can get more consistent income. Thanks everyone for watching.